I recently came across two companies from a sector that are growing at an exponential rate. First company has grown its revenue by 56% in trailing 12 months and net profits has grown by 62%. Second company has grown its revenue by 122% in trailing 12 months and net profits have grown by 275%. Not only that, first company has guided for 30% growth in revenue for FY25 and second company has guided for 100% growth in revenue in FY25. Can you guess the name of the companies? Well, it's AWFIS and EFC. Both are part of a very unique business model in India, which is co-working space, also known as flexible workspace industry. Hey everyone, my name is Sahil and this is my Personal Finance Academy. I recently did a detailed analysis on the co-working space of India, which is growing at an exponential rate. Since this was a completely new sector for me, I had a lot of questions around the business model, important KPIs, future growth plan, key players in the industry, and most important question, what are the key risks for the industry? And after my analysis, I found the sector very promising for growth in 2025. That's where in today's video, I'll share every possible information that you need to decide if it is worth investing in this sector or not. Also, we'll look at two listed companies in this sector that are AWFIS and EFC and try to understand their business model and future growth plan. By the way, I'm not sure how many of you are aware, but there's a company in US named WeWork that pioneered this concept of co-working space. At one point, it used to command a valuation of $47 billion, but today it has gone bankrupt. So we'll figure out what went wrong with WeWork and is it a threat to Indian companies as well. Alright, let's get started. Let's first start with understanding what is a co-working space. So it is nothing but a shared office space where people from different companies work together. It could include your freelancers, startups, small and medium-sized businesses as well as big corporates. Co-working space are not just places to work but also where people can collaborate, network and share ideas. Now you might ask, what is the benefit of working in a co-working space? So the biggest benefit is cost saving. A freelancer or a startup do not have a lot of capital to start their business. That's where they can opt for co-working space where they can get a fixed number of seats and get a pass for a specific time period, like a few days, weeks, months. So it's a great option for freelancers and startups. And as the team size expand or reduce, they can increase or decrease the seats. Also, post-COVID, there's a trend where companies are working in a hybrid model, where employees can work from home and come to office for a fixed number of days in a week or a month. That's where these co-working space offer that flexibility and help in saving cost. Now there are two models within co-working space. First model is called the straight lease model. Under this model, the space owner or landlord leases space to flexible workspace operator for a fixed rent. And the workspace operator invests capital to set up working space that include interior, furniture and so on. And then further sublease the property. Then there's a second model called managed aggregation model. Please understand this very carefully. In this model, the workspace operator ties up with the landlord or developer and they together incur the expense to set up the interior, furniture and so on. In fact, a major chunk of capital expenditure of 50 to 90% is done by space provider, that is the landlord. In return, the landlord or space provider becomes a partner in revenue and profit with the workspace operator. Here, please note that both these models have pros and cons. For instance, the straight lease model's biggest advantage is during good times when the demand for co-working space is high, workspace operators can lease the property at lower rate, set up the office and further sublease at higher rates and make a good profit. However, please note that this is a capital intensive model because the entire office setup is done by workspace operator. And when the demand is low, there's a big risk of something called asset liability mismatch. In fact, this was the biggest reason behind fall of WeWork as well. So WeWork was a fast growing company in the US and they were expanding business big time by getting into lease agreements with landlord. Usually these agreements are long term in nature, say 3 to 7 years. However, during COVID, people started working from home. Hence, the demand for co-working space collapsed drastically and corporations cancelled their agreement. Eventually, WeWork ran out of money. That's where the second model, that is managed aggregation, where the partnership is with landlord comes into picture, where rental cost and capex cost is lower and that helps in reducing asset liability mismatch during difficult times. However, during good times, the workspace operator has to forego a chunk of profit as it is in partnership with the landlord. So the profit is shared. So if you look at EBITDA during good times, it would be higher in straight lease model. But managed aggregation model has higher ROCE as the upfront capital investment is shared with landlord. So payback period in case of managed aggregation model is much higher as compared to your straight lease model. I hope you got a clear idea of pros and cons of both business model. In simple language, straight lease model makes more money during good times, but it is more risky. Whereas managed aggregation model is less risky, but profit growth is lower than the first model during good times. There's another way workspace operators reduce their operation risk. So apart from providing co-working space to freelancers and startups, they also get into long-term lease agreements with big corporate houses, where they set up the office for the corporates as per their preference and provide the entire space to the corporate. This is called managed office space. Here the lease agreement with corporates are long-term in nature, say 3 to 5 years. This ensures that there is full occupancy during that period, and that helps in avoiding asset liability mismatch. Now let us look at the key growth drivers for the sector. Okay, before we get into the growth drivers, I just want to clarify one thing. I get a lot of queries where people ask me, Sahil, whether you give buy or sell call or give price target in your weekly series or not. So please note that this series is only to share my own investment strategies and stocks I am adding or selling from my portfolio along with proper reasoning behind the decision. It's not a buy or sell call. A lot of people want to invest in stock market but do not get enough time and do not have enough knowledge. That's where I try to add value by doing 8-10 hours of research on a daily basis because this is my passion. I also track more than 200 quarterly results that really helps in identifying investment opportunity. In case you are also a long-term investor and want to join my exclusive community, you can explore my website. Link I provided in the pinned comment. Moving on, the first biggest growth driver for co-working space is rise of startup culture in India. In 2010, startup occupied 2% of office occupancy in India. In 2021, the number rose to 10%. Since co-working space provides the flexibility to select seats as per employee count without putting upfront capex, it's a preferred option by many startups. Although last couple of years have been tough for Indian startup from funding point of view. But with interest rate cuts in the US, I expect the liquidity to improve in second half of 2025 and money should also flow into emerging market like India. That should eventually benefit the co-working space. Then second growth driver is change in corporate trend. With increasing hybrid work culture in India, a lot of corporates are willing to opt for managed space from co-working companies rather than doing upfront investment in your office space, interior, furniture, etc. Here, one key trend is the rise of GCC, that is Global Capabilities Center. For instance, recently Google has leased a massive 5.5 lakh square feet of office space in Gurugram, making it one of the largest managed workspace deals in India. Likewise, there are many GCCs transactions happened last year in Bangalore. These GCCs account for nearly 40 to 50% of grade A office space in India. Plus, they make long-term deals, which is good for co-working companies. So this is one trend that would play a key role in growth of co-working space in India. As per Avendus report, this co-working space sector of India is expected to grow from 61 million square feet in 2023 to 126 million square feet by 2028. In terms of revenue, it is currently at around $3.5 billion in 23 and is expected to touch $9 billion in next 5 years. That's a very strong 21% CAGR growth expected from the entire sector. So obviously the top companies in the sector are expected to grow at much faster rate. Now let us look at the top listed players in Indian co-working sector. Friends, before we get into the stock names, please note that there are 3 very important KPIs that you need to track while analyzing co-working companies. First is total number of seats. It means the number of people the operator can accommodate. If seat count is increasing, it can result in higher revenue provided the seats are occupied. To gauge the future growth of co-working operator, you need to track how many seats companies are planning to add. Then second KPI is occupancy rate. Just like hotel sector has a fixed cost, co-working space has a fixed cost of leasing the property, setting up the interior, furniture and so on. So the occupancy rate plays a very important role in the profitability of the company. High occupancy means higher profit and lower occupancy means lower profit. And third KPI is average tenant tenure. Ideally, the tenant tenure should be on higher side as that gives a more predictable stream of revenue for the company and avoid issue of asset liability mismatch. Now the first company in this space that I want to discuss is AWFIS. Incorporated in December 2014, AWFIS Space Solution is the largest flexible workspace solution company with a presence in 18 cities, 180 centers and 110,000 seats. Please note that company has 67% revenue coming from managed aggregation model that we have discussed in detail and remaining from straight lease model. Company has also tied up with companies like Prestige State under the managed aggregation model. Its occupancy rate is 73% and centers that are operational for more than 12 months have an occupancy of 84%. Weighted average tenure is 33 months and average lock-in period is 24 months. Please note that 90% of company's business is from metro and tier 1 cities, remaining 10% from tier 2 cities of India. If you look at company's revenue, it has grown from 154 crore in 2019 to 1000 crore in trailing 12 months. That's more than 6 times growth. Operating profits have grown from 3 crore to 53, 68, 157, 246 and now at 314 crore in trailing 12 months. Although the company has high borrowing of around 1000 crore due to which it ends up paying high interest and also there is high depreciation and hence net profits were negative till 2024. Although the company is generating excellent cash from operation. Company has recently got listed in May 24 at levels of around 383. Its share price has zoomed to touch highs of around 900 but then has corrected around 25%. If you look at company's leadership, Mr. Amit Ramani is the chairman and MD of the company. He has around 20 years of experience in real estate segment. Overall, the leadership team is quite experienced. As far as future growth is concerned, company's management has guided that their total operational seats would increase from 1.1 lakh currently to 1.35 lakh by FY25 year end. So that is an additional 25,000 seats to be added in H2 of FY25. On revenue, management has given 30% revenue growth guidance for FY25 and expect this number to further go up. Then second company in the segment is EFC. The interesting aspect is that EFC is into straight lease model. Plus EFC not just designed the interior before leasing the space for renting, they also have their own furniture company. So it is backward integrated. They've recently started furniture segment which is expected to contribute around 15% in company's business by end of this financial year. Company has presence in 9 cities with 50,500 seats having an occupancy rate of 90%. Company enjoys a rental ratio of 45:100. That is for every 45 rupee of rent company pays, it receives 100 rupees of rent from sublease. If you look at company's leadership, Mr. Umesh Sahil is the chairman and MD of the company. They have not provided much details here. If you look at company's financials, its revenues have exploded from 0 in 2022 to 100 crore to 400 crore and now at 530 crore. And net profit zoomed from 0 to 4, then 63 and now 100 crore. What an extraordinary growth. As far as future is concerned, management has guided to increase the seat count from 50,000 to 70,000 in FY25 and revenue is expected to grow 100% in FY25. In terms of share price, it got listed in 2020 at levels of around 10. And since then, stock price has skyrocketed. In last 1 year, stock price has grown from around 400 to around 600. Now let us quickly look at comparison between both AWFIS and EFC across parameters. So if you have a quick comparison between both the companies, market cap of AWFIS is bigger than EFC. If you look at the business model, AWFIS is managed aggregation, which is 2/3 and EFC is straight lease. Total seats, if you look at AWFIS is 1.1 lakh seats versus 50,500 seats of EFC. Office area is 6.6 million versus 2.4 million square feet. Occupancy rate of AWFIS is 73% and EFC is 90%, so much higher occupancy rate. Trailing 12-month revenue is 1000 crore of AWFIS versus 534 crore of EFC. Operating margin is 31% for AWFIS and 45% for EFC, and that's mainly because it's in straight lease model, and as discussed during the upcycle, they will make more operating margin. Then if you look at trailing 12-month operating profit, it's 300 crore versus 239 crore. Revenue growth is 56% and profit growth is 62% for AWFIS, whereas EFC has grown at a much higher rate of 122 and 275%. Then ROE is not applicable for AWFIS, but it's 23% for EFC. ROCE is 73% and that is annualized ROC based on H1 of FY25 performance. If you look at screener, it is showing ROCE of 9.18, which is not the right picture. So ROCE of AWFIS is much higher as compared to AFC, and that's mainly because of its managed aggregation model where the upfront cost is low. Debt to equity of both of them are quite high, and in fact AWFIS has much higher debt as compared to AFC. CFO to EBITDA is 84% for AWFIS. So company has got excellent capability to convert EBITDA into cash, and that's a very important parameter. EFC CFO to EBITDA is only 15% as of today. Promoter holding is 28% for AWFIS, and look at the institutional holding, 47.4%. So institutions are showing a lot of confidence in the company, and that also include companies like Goldman Sachs, and then DIs include names like HDFC, Invesco, Nippon. And if you look at public, it has got a lot of HNI investors that have invested in the company. Next, finally, if you look at the valuation part, price to sale of both the companies is at par. EFC is slightly on the higher side, but more or less same. EV to EBITDA is also similar, although EFC is slightly on the lower side, but both of them are looking decent. P ratio for EFC is 33, but we can't look at PE of AWFIS. Final piece is future guidance, where AWFIS is given 30% plus revenue growth guidance for FY25, whereas EFC is guided for 100% revenue growth in FY25. Now let us look at the last segment of this video, which is also a very important one, that is key risk that can be antithesis in company's growth journey. So the first risk is asset liability mismatch. As discussed earlier, if co-working operators lease space from landlord for 5+ years but sublease for a few weeks, then there's a risk of low occupancy. That can be a key risk to keep in mind. That's where the co-working operators prefer companies with long-term lease agreement, and that's where your GCC comes into picture. Second risk is rental ratio risk. Co-working operators need to ensure that there's a good margin between rent they pay to the landlord and rent they charge. Ideally, the rent should not exceed 45 to 48% of company's revenue, because if the rental ratio is much higher, it would result in fall in earnings. Then third risk is competition risk. Co-working sector is more of a commoditized segment where there is not much differentiation in terms of office space. So if there is a high demand today and if the sector is profitable, it will result in more competition. That could result in higher supply as compared to the demand, and that could result in fall in profitability. Today everything is looking good because there is more demand and supply is less, but then there can be a case where demand reduces and the supply increases as compared to the demand growth. The only way to differentiate is by increasing value-added service, then provide a consistent experience along with building a reputation in the industry. Then another way to differentiate is optimizing cost by providing economy of scale or backward integration. Then fourth risk is concentration risk. Co-working companies need to ensure that there is no dependency on a few companies or a specific sector or a specific geography. Because if there is high dependency on let's say few companies or a few sector or a geography, and if there's a problem within that company or slowdown in the sector, then can badly dent the business. So in this video, we discussed the fast growing co-working space of India. We looked at difference between straight lease versus managed aggregation business model, key growth drivers for the sector like rise of startup ecosystem in India, growing GCC presence in the country, change in corporate trends. Then we looked at two leading companies in this space, AWFIS and EFC. While AWFIS is more inclined towards managed aggregation model, which is relatively less profitable as compared to straight lease during good times, but also is less risky as compared to a straight lease. That's where your EFC has adopted. Since we are in strong upcycle in the industry, EFC's revenue and profit growth is much faster, but in the long term, EFC business has higher risk as compared to AWFIS. As far as future growth is concerned, both companies have projected high growth in FY25, although EFC growth is much higher than AWFIS. And then finally, we looked at the key risk in the business. Overall, co-working space in India is really looking very promising, but this sector has its own set of risks that you must keep in mind before investing your money. Having said this, considering the upcycle in this sector in 2025, you may consider it as a part of your satellite portfolio. But please note that exit would be very important in this sector. Now tell me in the comments, what is your take on co-working sector of India? Is it worth investing money in 2025? Mention it in the comments. And if you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.